welcome to Geared for Growth. I'm your host, Mike Mortlock from MCG Quantity Surveyors. Today, we have a previous guest coming back on the show. We've got Darren Venter from the Investors Agency, who is a very data-centric person and investor, a man after my own heart. And we talked to him about the difference between white-collar and blue-collar markets, as quite distinct from, say, a blue-chip market and a regional market, but we do discuss the parallels. He shares some really interesting insights into how those markets behave differently, where he sees the opportunities are, and he gives us some of his secret herbs and spices at the back end of the interview, so I'm annoyingly throwing that out there to make sure you listen to the end. But even more special than that, at the end I give him three-part question with the opportunity to answer either one. And the first one is his future predictions for Melbourne, his future predictions for the Perth market, and what he thinks will happen to the property investor market when we start seeing interest rate cuts. And he generously takes them all on board. It's an awesome interview with Darren, and I'm sure you'll get something out of it. Here's Darren. Darren Venter, thanks for joining me back on Geared for Growth.
Always a pleasure, Mark. Thanks for having me back, mate.
It's been quite some time, but we're not going to go for a trip down memory lane. We're going to go straight into a topic, something that you kind of suggested might be interesting to unpack, and that's the difference between blue-collar and white-collar markets. Often we talk about blue-chip markets, and it's always sort of seems to be, you're either buying in the regions or blue-chip, but then, there are also cities that aren't necessarily blue-chip when you're looking at pockets. But I'm interested to unpack this idea. What are we talking about when we're talking about blue collar and white collar markets?
Yeah, I mean, look, there's a big variance out there with a lot of people obviously getting into the investor space, and it comes down to a lot of the time when there's potentially just a lack of education around what actually supports who and how that actually happens. And I think the biggest differences between these markets is literally just the education around them, and how they can support independents, or how they can support investors rather, in two different ways, or multiple different ways really. When you're looking at those sort of blue collar markets, you are looking at a lower entry point market where you're typically, paying a lot less to get into a property. And obviously that makes it a lot more affordable and a lot easier for investors to get into it. But it's not necessarily considered as safe as the general sort of white collar market. And that's just because there's a lot more education around those white collar markets. And the general investor population are white collar populations themselves. They're the guys that can pretty much earn a better wage. They can have a little bit more to spend on their luxuries and their futures, and I guess that's where the familiarity sort of sits with those people, is that, well, I live in this area, I think I should invest in this area. But the truth be told is that it's quite an unaffordable area, and quite an unaffordable climate at the moment in Australia to invest in. So when you are investing and you can't afford to invest in where you are, which is potentially a white collar market, you do have to look at those blue collar zones. And that's basically what we wanted to sort of unpack and explain a little bit about what the differences are about those markets today, I guess.
Sydney's been in the news recently where there's a sort of a mass exodus of families because people are saying it's unaffordable. And we heard a similar story probably 24 months ago with Byron Bay being the highest median price suburb in the country. Yet there are people there that have jobs in hospitality, baristas or people waiting tables, but couldn't actually afford to exist in that location. So there's kind of like a dearth of employment let's just say they need a workforce, but people can't afford to live for the money that they're getting paid. Is that a consideration for some of these white collar markets like Sydney, and that can influence the property growth?
It is a big influence. But I think also, just to go back a bit there, Mike, you actually just picked on something quite important and quite unknown to people, is that Byron Bay is a regional area. It's a regional town, and it's not necessarily considered a CBD. And it is not a CBD. It's not a major CBD, at least, rather. But it is a white-collar market. And so there's a bit of a difference in the type of quality or the type of investor profiles in these areas. It's very murky at that level. And it comes down to where it's pretty much was, as you said, 15 or so years ago, where it was quite an affordable market to get into an area, and it offered a lot of opportunity to sort of the retirement market. And there's quite a few different types of markets that are gentrifying, and they profiled in different ways. And like the new home buyers, the upgraders, the downgraders, the retirement markets, and so on. But when you look at Byron, what it used to be, it really did used to be, it came up really from a retirement market. And retirement money came forward with that. And pretty much back in the day, there's a lot more opportunity to make money. Well, there's a lot easier opportunities to hold money rather than make money, let me put it that way. And that kind of flowed into that market where stimulation from that population has moved in. And obviously with that, there's a demographic that comes in, a retirement demographic, which is typically a little bit older than the newer white-collar CBD area populations. And with that is the need for hospitality is one thing, like you mentioned there, but hospitals are another thing, and hospitals need staffing. And there's always this discussion around, well, where's qualified medical attention come from? It comes from the newest studies from a university, who are the most recent graduates. And so those eventually come into these markets as well to support the retirement market, who are a gentrifying older nature of people. And so it starts to murk the waters a bit, where you've got like a rising population, which is being fueled by another population who's been there or who have moved into these markets a while ago because they've been taking advantage of their retirement funds inside these markets. So you've got two different types of tenants inside these markets, and obviously the retirement market is more so a homeowners market in Byron Bay, whereas against the younger generation in Byron Bay, which is probably more of a rental market. But even so, those rental rates are very much lowly yielding inside these areas. So it's not necessarily a great area to invest in if you are looking for a good yielding support. And generally, if you're looking at what a white-collar market is, quite a low-yielding market, quite generally speaking. And that's because there's a longer, steady growth of value inside that market, and the rental returns don't necessarily grow at the same rate inside those markets. So the value being so high in Byron Bay versus the rent being not as high there creates a yield which is a lot lower, and therefore it's kind of considered a slower burn growth market in Byron. But we also do know the market in Byron has also peaked, and we're looking at a slow of the area too at the moment. So, it doesn't mean that it's not going to be a white-collar market continuously. It just means that it's not going to perform necessarily as long as what other CBD white-collar markets do. So you've got to take it with a bit of a pinch of salt. It's not necessarily a regional blue-collar. It's more of a regional white-collar market.
Yeah. I mean, it feels like there's got to be another category of, say, green collar, right? Like Byron Bay sort of became famous as sort of an undiscovered hippie town where people are maybe much less likely to have any job rather than, say, a blue collar or a white collar job. But now it's sort of got to the point where all the things that attracted people to it are kind of gone. Like, it's expensive, it's discovered, it's full of, high net worth individuals. It's got a bloody Hemsworth in it. There's a lot of people talking about where the next Byron is, because I guess it's completely changed to what it was as a bit of a hippie outpost, say 20, 30 years ago.
Yeah, it has changed a lot, and that's probably one of the most important parts about any market. So if we step outside of Byron for a bit, and we actually look at what's happened in Perth recently, or what happened in Queensland before, sort of lead up to 22 and 23, those markets have all been gentrifying, and change is the biggest part of a market's growth. And it really is the very important economics factor around how you grow your capital within a suburb. Now, obviously, just touching back onto Byron there for a second, obviously the retirement markets, because they're leading the way there in the value, it doesn't gentrify past retirement that much. So there is going to be a stagnation period until new populations can come in that can afford those properties inside those areas. And so that is why those areas don't necessarily continue to grow, or rather they don't erupt in their growth as much. They're more of a very much slower burn. But if you do look at these regional markets where there is this change which is happening, and it's happening pretty much at sort of like the 25th percentile value in the markets, where there's affordability inside these areas, and the local population, and when we look at the whole of Australia at the moment, it's really unaffordable. So when I do say that it's the more affordable areas, it's the more affordable areas. It's not to say that there are very affordable areas, but
not actually affordable, just more affordable than somewhere else, right?
Exactly. I mean, honestly, like it's a real game of throwing a dart at the moment. But at least it was. I think that's kind of slowed down a bit now. But that change that we see coming into these markets is very important. Like we say, and you've got a market which has got a 30% affordability belt, and a lot of these people are needing an affordability at this stage because the cost of living is just really traumatic. So these people look for new places to live in, and they basically have to downgrade to other areas. And while that's happening, there's a movement of market, and those people are moving to other markets, and it's becoming a fight for affordability at the moment, and that's what's driving price. And typically, like I said, that happens at the lower percentiles, typically around the 25th percentile range of that market. So below the median is kind of where you see it, but that fuels the median value at the same time. And once that happens, that's when you're pulling out your equity from your properties.
Interesting. Now, I want to ask you about the actual people that live in the location, because if we think about white collar versus blue collar, I mean, you can make the parallel between, say, blue chip or traditionally regions, but I'm guessing the actual the employment sector that is dominant in a location has a big correlation with price movements. And I think there's been plenty of people that have sort of debunked the importance of population as a major driver for price growth in favor of things like employment opportunities. So let's say we're thinking about two regions side by side, somewhat affordable, let's say a median house price of 600,000, but you've got one particular market that has, say, 40% are professional people, degree educated. We're talking about, maybe doctors or lawyers, accountants, those sorts of things. But another market which is much more a blue collar workforce, let's say there's mining or there's trades or those sorts of things. How do you look at the difference between those, and what typically does your brain go to in terms of the market performance across different cycles with that different employment makeup?
That's a great question. When it comes down, there's a lot of factors there, though, Mark, and you need to consider all of them at the same time. That's the biggest issue here. Is a lot of people will look at those mining towns, and the data looks great, and it all looks favorable to invest in, but the reactions further to that are really what needs to be considered there. Population is one thing, employment is another thing, government funding is another thing, interest rates are another thing as well. And they all really do play a part, because they all come into pretty much being able to afford on your current salary and what's going to stimulate you for more salary in the future. When you're looking at a market such as, if you look at Mackay, there's a couple of pockets in Mackay that are doing really well, and they're expected to do very well. It's not one of our favorite markets to shop in, and typically we actually don't shop in there, but it's because there's a high vulnerability status on Mackay at the moment. And that comes down to the fact that while those pockets that are working quite well are working well, it's because there's been that push of movement in the prior markets as well. It's kind of getting to that point where at the moment now we're sort of seeing the last bit of available growth in Mackay going into Mackay. And that's not to say that it's not going to continue or it's not going to change in the future. And that's the really important part, is that right now that area is growing, and it's getting to a level where right now it is potentially going to start slowing. However, there are a lot of other economic factors which are going to be playing into that, such as the interest rates. When they start to come down, affordability is going to increase inside those areas, more so for house buyers than for renters. And that means that the prices inside those areas are going to become more affordable for potentially the local population, which is then going to drive competition inside that area for the local population who are potentially renting at that stage. So as those rates come down, those areas will become more affordable to the local population inside those areas, and they will start to stimulate that growth. When it comes to the economic side of employment, projects are abundant in Mackay and around that sort of central Queensland belt. And so that also does help for new money to come into areas. And when you have new employment, which is creating new money, there's new wealth, that's going to then again increase the affordability. So I'm saying right now, we're waiting for these reactions to actually respond so that we can be confident about getting into that market again potentially at some stage. But we have to wait for those things to react. Now, when you take that situation and you compare it to a white collar situation or blue chip suburb, that's a very different response. Those people are pretty much on a wage which is on a steady annual growth of, let's say, 3.5 or 4% per year over their very cushiony jobs in the CBDs, and they know what their mortgage repayments are going to be, and they're quite secure in their employment, and they know that this is what I can afford, this is where I can put my money, this is where I'm going to stand, and this is where I'm going to sit. Now, on the biggest scale, when it comes to CBD, another 20,000 jobs is not going to make a difference to the grand scheme of a CBD for employment. It's not going to change much of the economic impact of that area or even a particular suburb or even a postcode zone. So those kinds of factors don't necessarily play a big part. But again, when you come into the interest rate side of things, those will then play a big part because that's going to pretty much affect everybody. So it does just depend on what you're looking at inside which area, but also sort of what different factors you can consider to be supportive of those areas, like employment. And Mackay, for example, has good opportunity for employment coming forward, and so we can expect things to change there, which will bring that new money. But again, like the new CBDs, the major CBDs, not so much. And so those factors are more reliant on the interest rate changes, more so. And population really doesn't play as much of a part in terms of suburb population, but the immigration side of things does play a big part on CBD influence. So it's a bit of tit for tat and a bit of push and pull depending on what you're looking at and what you can consider in those different markets.
Yeah, I mean, in some respects, it's annoying, right? Because I just want one metric to go, like when that moves, that's when you go in. But you're saying that it's quite nuanced, and there's a number of factors which, annoyingly makes perfect sense. And it's, I guess, if it was easy, everybody would be doing it and everybody would be a billionaire. If you go back in time, let's say 30 or 40 years, the wage disparity between, say, a white-collar worker and a blue-collar worker is probably greater than it is now. I mean, it sort of seems like we hear stories about these tradies on, $180,000 a year, or these FIFO guys on $250,000, and there's probably white-collar workers going, gosh, why did I waste time going to university? But I just want to pick up on something that I sort of gleaned from you, and it's that white-collar markets and blue-collar markets doesn't necessarily have an influence on what people are earning. I mean, blue collar markets could, there could be more money available, but there's a degree of volatility in blue collar markets where a project could come in and disproportionately really drive some employment opportunities in more of those blue collar markets, where in white collar markets, they tend to be a greater population base. As you say, projects that add 20,000 jobs are a little bit of a drop in the ocean. But is this kind of pointing to the fact that the blue collar markets tend to be regional markets where it's a smaller base, where something happening actually has a bigger impact just because it's a smaller location?
The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Nail on the head, exactly that.
Well, that's good.
And we've seen that. We've seen that a lot, especially in Western Australia, around around Perth, southern suburbs, where there is obviously the southern suburbs are quite pocketed. There's a small, pretty much a small degree population, which makes it quite easy to comprehend the the data inside these areas, because the reactions are tied to the population or the suburb code. And because there's a smaller amount of people or smaller amount of dwellings in all of these different suburbs, it's much easier to understand than it would be for, say, a white-collar suburb with this high density. Now, again, Perth is a major CBD, or at least Perth is a major city in Australia, and but if you look at Perth, now Perth is regarded as a regional area, but it is one of Australia's major CBDs. And those southern suburbs, just going back to the population sizes, because those suburbs are so small, and you can actually see what those wages are inside those areas, and you can see what the general cost to purchase and the general cost to rent and the general cost to hold a property inside those areas is. It's way easier to understand where that affordability sits at a very pocketed situation. Very much different to when you take those major CBDs in, let's say, New South Wales, like Sydney, or in Brisbane, where there's a dense population around those suburbs, which is a little bit more difficult to understand what that demographic is looking at for affordability. So, like you said, you wish there was one type of data that you could pretty much consider fair for all, but you really do need to segment it down, and you can't take white collar and compare it to blue collar. It's very, very different. And those pockets of suburbs, that's why we actually like to go into sort of, I wouldn't say regional towns necessarily. We do shop in regional. We also shop in outer metro. And I consider outer metro to be sort of our cream, because outer metro suburbs, you can actually segment those markets quite well. And you can see what the cost of living is inside those areas, what the sort of employment looks like inside those areas. You can understand the demographic profile and breakdown inside those areas. And if you analyze all of that for all the 15,000 suburbs in Australia, you can really get a good idea of what is moving, when it last moved, and what's expected to move next. And I think, that's the really hard part about it, is comprehending that data, especially at that massive volume. There's 15,264 suburbs, according to the Google searches, but there's actually only around 6,000 suburbs in Australia. The rest of them are called name places, and those are like let me put it this way, there's only really about 6,000 investable suburbs in Australia.
Yep.
The rest of them are called name places. And that's just because there's really not enough data to be considered investable suburb, because there's just not enough activity inside these areas. So you can't consider the same fact for all. You have to break it down. And I think that's where we sort of really like to sit in those other metro areas and break that down a little further.
Now, when you speak about affordability, I think typically we can fall into the trap of saying, okay, well, Sydney median house price, let's say it's $1.1 million, and let's just pick a regional location, Dubbo, median house price, $550. I made that up. I don't know what it is in Dubbo, but it's less. But we could say Sydney's not affordable, but Dubbo is. But doesn't it really depend on what the median household income is? So actually, the average Sydney sider might only be spending 30% of their salary to satisfy mortgage repayments, whereas in Dubbo it could be 45%. So in real terms, Dubbo actually has less affordability than Sydney. Now, this is not factual information. This is a hypothetical thought experiment. I don't want people going like, I'm not buying in Dubbo because it's less affordable than Sydney. But is that part of the equation that you're looking at when you sort of say an area is affordable and an area is not affordable?
It's the exact equation. So we look at it from a rental standpoint as well as a purchasing standpoint. So the cost of a mortgage or the cost of a rent return or a rental rate over the year, according to the income of that population inside that area. But what we like to actually do is sort of trend that, because if you're trending it in historical data, you can see which way it's going, and that sort of gives you a bit of an insight into what's happening inside that area from a council support area or council support or a LGA support perspective, where you know that there's additional funding for new employment or there's additional projects going in. So it's exactly the equation. Pretty much, if you take the cost of a mortgage and you divide it by the salary, that's going to give you your or was it the other way around? I forget which way around it is. But it's going to give you your affordability. And anything under 30% is going to be fantastic to invest in for at least the potential growth opportunity. But at this day and age in Australia, there's not a lot that's sitting underneath 30% that is a good foundational area to invest in, at least that we can see. But yeah, that's pretty much the equation. If you want to just do it at a rental and a purchasing standpoint, I think that's where you're going to get a really clear understanding of where you should be buying, especially if you trend that backwards, because we all need at the moment cash flow. We all know that cash flow is really difficult to get in a property at the moment, and until those rates come down, nothing's going to change. But you can actually take those rates and you can trend those rates of the cash flow, of the cost to purchase with the interest rates holding costs, as well as comparing that to the rental holding costs. And when you compare all three of those together, you get some really interesting data. And the data that we're seeing at the moment, in accordance to the the interest rates being tied to rental rates, has an effect at sitting around that sort of like 3.8% mark. So the 3.8 to 4.5% interest rate is where we saw the biggest amount of homeowners converting to rentvestors or renters rather. And that was basically through the changes that we had from 2021 to where we are today. And that shift there from pretty much I think it's about 3.6 to 4.2 or 4.5, somewhere around there. Can't be positive about that right now, but that's where we saw the biggest shift of buyers becoming renters. And so when that starts to reverse itself, we can expect that to start happening again somewhat. And when you're looking at the rental market in an area at the moment, because typically, generally speaking, historically, the rental market was sitting around 30% rental market towards 70% homeowners. At this day and age, it's sitting closer to that sort of 40%. But again, we feel like that's going to relax a little bit when those rates start to change.
Yeah, that's really interesting that there's sort of like a crossover point in interest rates where people decide that it's better to be rent vesting and use that money to invest because the PPOR is kind of holding them back. So that's an interesting one to keep an eye out. So keen to have you back on that. But I'm a huge advocate of the expertise of buyers agents, not just from an asset inquiry point of view, from a research, but also negotiation and all the dark arts that buyers agents can do better than the average person just by sheer volume that they're doing all day, every day in the relationships. But I always like to sort of ask the question from the mindset of someone that is trying to go at it themselves. You've sort of said that you need to be investing in markets where there's enough transactions that the data is reliable, right? So we can't just go, okay, well, there's a place in far west Arana where people are only spending 15% of their wage on housing, so that's going to go through the roof. So let's look at a place that sort of matches that description. It is affordable from a salary to asset price or a salary to rental affordability point of view. The other ingredients I'm assuming that we kind of need are, projects, a bit of buzz, some employment opportunities, some expansion, those sorts of things. What else kind of characterizes a market that is worthy of further inquiry from your side of things?
Well, I mean, if you're looking at it from a data perspective, the reduction of days on market is always going to be a really good indicator for the amount of demand that's inside an area. And that's quite easy to look at on realestate.com.au or websites of the such. It does show you that data and it shows you that historically. So if it is very much publicly available to a lot of people to go have a look at. But I'm going to drop a little nugget for you guys all here. One of the things that we like to do is, inside these markets, when you've got a really large amount of competition and it's very difficult to secure those properties and you do have that very short days on market, what it typically means is that, if you actually have a look at a lot of the data, when you find a market that has, let's say, 17 days on market or 12 days on market, typically that doesn't really fundamentally make sense because the contract exchange until settlement is around 2 weeks. And so, around 3 to 4 weeks, depending on when we're shopping really. So now that time frame is more than 17 days. Yes. And generally speaking, at least. If that's the case, that means that a lot of the properties which are being sold and transacted in that market are actually being sold off market.
Right.
So taking that data set, understanding that, because a off-market property is qualified as 0 days on market, and the on-market runs the full campaign till settlement deadline. So if it's lower than 2 weeks, 17 days, or if it was lower than 3 weeks, rather, sort of 17 days or lower than that, then you can be quite confident that you're shopping in a market which has a lot of off-market opportunities. How to get those off-market opportunities is the other side of things. One of the things that the major portals, I'm not going to name either which or, but what they do is they show how they potentially show what a really good agent is doing inside those areas, and they show how many transactions that agent's doing inside those areas. And they put those people at the top of the list so that people contact them. And obviously agents pay for being at the top of the list, but they also are around the performance. And if you are a quick performer and you do a lot of transactions, you can get to the top of those lists quite quickly as a selling agent. But how they do that is necessarily not by running the full campaign. It's by selling a lot of off-market stock. Because that is when you can transact quick. And then that basically tells us that if you want to get an off-market opportunity, contact those agents directly to get something from them, or at least get into their database for those off-market options, and then try to take advantage of that situation. It's something that we like to do on our side here, is that we pretty much look for the top listed agents for the transactional amounts, and contact them off-market, contact them privately for those off-market options.
Wow. I mean, it's not often you get a buyer's agent giving away some of their secret herbs and spices. So we appreciate you sharing that one with us, Darren. I'm interested in one of the sort of things I had scribbled down is, who's best for each type of market, talking about white collar versus blue collar. We've characterized them as, blue collar has more of I suppose a volatility to it. It can see bigger swings than perhaps a white collar market, but they're generally easier identified by kind of purchase price, right? So do you have a comment on which particular investor should be looking at white collar versus blue collar? I mean, the traditional notion is that, some of these white collar markets can see great capital growth, but from a yield point of view, very, very difficult to hold on. You'd have to almost have a bit of a cashy style portfolio before you get involved, or are there deviations to that sort of theory?
Yeah, there's a big look. It comes down to palatability, really, and your comfort to invest in certain areas. Over the long term, and obviously this is excluding very vulnerable markets like the mining towns and the boom and bust stuff. Yeah. But on the general speaking, when you're looking at a really well-qualified outer metro area, or a very strong regional area, or if you're looking at a metropolitan CBD area, all of those markets over the long term pretty much have the same percentage reaction of around doubling in 7 to 10 years. They don't really have much of a difference in that period of that 7 to 10 years. But what we do find, and this is why we shop in those sort of smaller pockets, is that, and this is because we want to try and get our clients into new investments as quick as possible. So it depends on, let me go back first for a sec. What we do is we actually take a look at those smaller investment pockets to try and invest in, because that's where you get a more imminent growth cycle. And an imminent growth cycle typically lasts up to, can last up to 2 to 3 years. But typically counted out for about 1 or 2, and you can get pretty much a 20% gain within the first 12 months of that market, and close to that potentially for the next 8 to 12 months after that. However, after that, it then starts to teeter out inside the regional market or an outer metro market. And that's fine, that's not a problem. But what that's done is that's given our investors the ability to make a lot of equity really quickly, to repurpose into another property really quickly. So if you're an investor that doesn't have necessarily a large bucket fund of cash, and you want to invest in areas and you want to do it quickly and safely, we consider it safer because it's not necessarily your money, it's the bank's money. You're lending under debt, which is supported by better cash flow from those types of markets in comparison to the white collar markets. But if you're looking to get into properties by leveraging the equity and leveraging the bank, we prefer to go sort of those blue collar markets, because that's where you get a higher imminent cycle. If you are an investor with deep pockets and you are looking to reduce your taxes and offload your cash into assets with the general returns each year, the white collar is going to be there for you, and that's not a problem. Big bottom line is that 10-year cycle, or 7 to 10-year cycle, the percentage of return is going to be pretty much the same. Whether you can afford to buy all of them on your own with cash is going to be putting you into a white collar, or whether you want to leverage the bank's ability to help you and support you is going to put you into more of that blue collar zone. So those are the kind of ways you need to think about it, is that imminent cycle is far more eruptive on the outer metro and those regional markets in comparison to those white collar markets.
I love that. That's a great analogy. And we sort of get taught that, time in the market is more important than timing the market. But if you're not on $1 million a year and you are wanting to grow a portfolio in a short space of time, you do kind of need that quick and fast kind of upside to be able to get that leverage effect of moving into the second and the third one, right?
Yeah, and that comes down to timing the market. You really do need to time the market, because if you're timing it after it's done your imminent growth cycle, then you're really just putting your money into a market that's going to be stagnated for the next 7 or 6 years, or however long is left on that cycle. And then you're basically not going to be able to, capitalize as much as you potentially would. So it is timing the market. I know a lot of people say it's not about timing the market, but I'm a very firm believer it is about timing the market to be in that time frame for the market too. If you investing in a market after the fact that it's done its big equity growth and it's now relaxing, because we call that a correction, and the way that works is, unaffordability eventually reaches a belt. And when you are in a market which is unaffordable, eventually the competition inside that market stops, because the population cannot afford to continue to buy. And when they can't buy, they won't buy. When they won't buy, there's no more competition. And competition is needed for growth. So you want to be in that competition belt, and that timing the market is going to get you there at the right time.
I love that. Very, very good advice. Now, because I haven't had my coffee this morning and I'm in a bad mood, I'm going to throw some heat your way, but I'm going to give you 3 options. These are 3 crystal ball questions that all my guests would all hate, but you can pick one because, I'm not a monster. One is, what's going to happen to the Perth market in the next 5 years? The second one is Melbourne the next hotspot? And third, when interest rates start to drop, is property going to go through the roof or be vaguely the same? Now, these are all hot potatoes, so I was going to give you the option of which is the most lukewarm that you want to touch.
Let's go for all of them.
I love it. Swing for the fence.
All right. Perth itself, Perth Metro, will probably start to perform again before Perth Outer Metro. And I think that's going to be in light of sort of the very much outer metro and sort of outer suburbs being at a threshold which are being really close to the metro price. Once that happens, the local population start to see that, and then they think, oh, well, if I'm that close to the price range, why don't I just go to metro? So metro starts to go up again. So I think metro is going to start to go probably at around 2 years' time. I think Perth outer metro has still got a little bit to go. And affordability is still the best pretty much across the board if you're looking at a suburb by suburb comparison at a state level inside WA. So it is still better supported than any other state at this moment. So it does still have a little runway, but it's not an aggressive runway. It's a progressive, but not an aggressive runway.
Not 25% in 12 months, like it's basically done.
Not so much that anymore, unfortunately. No.
Okay.
Question number 2 was
Melbourne.
How's Victoria going to react? Well, that all comes down to our friend Dan, and if he decides to make this an investor-friendly market or not. But look, bottom line is the relaxation and the correction inside Victoria has been there for quite some time already, and it does make sense for it to start responding again. The only problem is that the yields are still not supportive enough inside these areas. So when there is going to be growth, it's going to probably be fueled by the downsizer market more so than the first-timer investor. And that means that potentially once that happens, there's going to be some relocation into these areas, and that's going to be more so in the white-collar zones, I would imagine so, than the blue-collar zones inside Victoria. So I say Victoria more than Melbourne itself.
Sure.
When it comes to the interest rates, yes, 100%. I purely and firmly agree. And obviously, I wouldn't be in this industry if I didn't think otherwise. But when those interest rates become more affordable to everybody that is a home buyer or looking to get into the market, that's when property is going to start lifting again. However, with that said, it's always lifting, and it always comes down to affordability. It just means that once affordability really starts to happen again, those areas that have been unaffordable up until right now, probably closer to those sort of the CBDs around Australia, those places are going to be first to go up again, because that's where everybody pretty much wants to live, is closer to those major CBDs. So we're expecting more growth when those interest rates start to reduce, probably around sort of March to April next year, I would imagine.
Wow. I've got to say, you're a good sport for answering any of them, let alone the three of them. So, Darren, thank you very much for playing the game and for sharing all of your wisdom today.
You're welcome, mate. I've put my head on the line there. We'll see what comes back with the wrath.
Oh, we'll be back. We'll be back. It's on record. But I think you're probably going to be pretty close to on the money. I can't see much sort of deviation from that. Maybe Perth is a little bit of a surprise that it's still got a little bit in the tank, but you've certainly got your head in the numbers more frequently than I do. So, yeah, be keen to see how it happens. But, thanks for not giving a politician's answer anyway.
That's a pleasure, mate. Thanks so much for having me on the show once again.
Cheers.